Welcome to the last section of lesson 3. In this section, we are going to talk about diversification using ETF. At the end of this lesson, we will also go through a few other popular ETFs. Let's begin by talking about ETFs that performs diversification for you. First and foremost, what is diversification? It is basically buying different type of assets so that it helps you to minimize your risk while maintaining a good return. History has proven that good bonds and good stocks will generate positive return in the long run. The problem is, risky asset generates higher return while safer asset generates less return. Therefore, to find a happy ground, you can buy a group of different assets, which helps you to diversify your risk while maintaining a good amount of return. This group of assets is called portfolio. And the best thing about the financial market is there are plenty of portfolio ETFs that you can buy. So you don't need to pick stocks yourself. In this section, we will introduce 4 types of portfolio ETFs. The first type of portfolio ETFs consists of a mixture of stocks and bonds. This type of portfolio ETFs is the safest ETF that will survive a bear market while generating a healthy return in the long run. I'm going to introduce 4 stock and bond ETFs, namely AOK, AOM, AOR, and AOA. AOK is rated more closely towards bonds, but it still has some stock in it. The return increases as we move from the left here to the right. So AOA provides you with the most return out of these 4 choices, but you risk losing more in a bear market because it has more stocks. The second type of portfolio ETF is index funds. These are extremely popular ETFs. They track different indices like Dow Jones, S&P 500, and the Nasdaq index. However, index funds can go down a lot during a recession, so these ETFs are more risky than the stocks and bonds ETF. There are a few examples of index funds. Here are a few examples of index funds. DIA is an index fund for Dow Jones, SPY is a popular fund for S&P 500, and QQQ is an index fund for the Nasdaq index. All of these are highly liquid index funds, so they are good investment that you can sell easily if something bad happens. The third type of portfolio funds are international index funds. These funds carries even more risk due to geopolitical events. However, they can be rewarding. Some example of international index funds are FXI for China, EWW for Mexico, EZU for Europe. The fourth type of portfolio funds are US sector funds. These funds are also very popular, and they can provide opportunistic investor with more return. For example, if you want to seek lots of growth, then the technology sector fund, XLK, might be a good fit for you. Some other examples of sector funds are XLF for the financial sector, XLV for the healthcare sector, and XLI for the industrial sector. Next up, let's talk about some other popular ETFs. Here are some specialty ETFs that I would like to introduce. They are mainly related to commodities. The first one is the gold ETF, GLD. Gold is a good investment when the currency of a country starts to go down. This will help you to hedge against inflation. The second ETF that I would like to introduce is the silver ETF, SLV. Typically, silver tracks gold, but it is much more volatile, meaning their prices fluctuate more. But its return can be much better than gold. The third one is the crude oil ETF, USO. This is a good investment if you have a thesis on why oil price might go higher. It is interesting to note that GLD, SLV, and USO only holds one type of asset. This shows that ETFs don't have to hold many assets. Lastly, we have an agriculture index fund, DBA. Basically, it consists of various agriculture futures. Again, if you remember from lesson 1, agriculture commodities typically go down. So DBA is not a typical asset that you would buy and hold for the long run. That's all we have for this section. Please take some time to go through the text below, as you will find more information. We have reached the end of our free mini course here. Thank you so much for taking our course. We hope that you find this course useful. If you would like to learn more about investing, we have some book recommendation at the end of the text. We also intend to come up with other courses. So if you would like to learn more about our new course, please sign up to our mailing list. You can find the sign up form at the end of the text. Also, if you have any questions or feedback for improvement, please send us an email at hello@stockandra.com. Once again, thank you for choosing our course for learning about the basic of investing. Hopefully, I will see you in our future courses.